Corporation tax is rising again in 2026, but smart businesses are already using legal tax hacks to cut their bill dramatically. Stay with me and discover the reliefs you're probably missing.
If you're running a business in the UK, listen up. There is a hidden tax trap coming in 2026 that's set to catch thousands of growing businesses off guard. It could actually cost you more than the top rate of corporation tax. But don't worry, today we're going to show you exactly how to sidestep it. So what on earth is this number all about? 26.5%. Nope, that's not a typo. That is the very real and pretty punishing effective tax rate that's going to hit businesses with profits between £50,000 and £250,000. And yes, you read that right, it's actually higher than the main 25% rate that the biggest companies in the country pay. Now, you might be asking, how is that even possible? Well, it's a strange quirk in the system, but in this guide, we're going to show you how to navigate it and legally and quite significantly lower your tax bill. And just so you know where all this expert advice is coming from, this entire guide has been put together by the tax advisors at My Tax Accountant. They've poured years of expertise into creating a clear, actionable plan to help business owners like you stay ahead of the game. Okay, so here's our game plan. First, we're going to tackle that 2026 tax squeeze and really get under the skin of it. Then we'll dive into your capital investment playbook. After that, we'll explore the innovation incentive, look at smarter ways to pay yourself as a director, and finally, we'll unlock some extra reliefs you probably don't even know exist. Let's get into it. Right, first up, the 2026 tax squeeze. Let's really understand this new reality. Okay, this table is absolutely key. It lays out the 3 tiers of corporation tax. If your profit is under 50 grand, you pay 19%. Nice and simple. If you're making over $250,000, you're on the main 25% rate. But the real story, the bit that affects almost every growing business, is that messy middle band. And look at that column on the far right. This catches so many people out. If you control more than one company, what are called associated companies, these thresholds get sliced. So an owner with 3 businesses hits that higher tax rate after just £16,667 of profit. This trips up entrepreneurs all the time. Okay, so where is the actual trap here for businesses that are doing well, the ones that are trying to scale up?
And here it is. That middle buffer zone taxes you at an effective rate of 26.5%. It can honestly feel like you're being punished for growing. But here's the flip side, and this is the real opportunity. For every single pound of profit you can legally reduce in this zone, you're not just saving 19p, you're saving 26.5p in tax. This means your tax planning becomes massively more powerful right here in this bracket.
So here is a massive tip. Always, and I mean always, check your associated company status. You might not even realize you have them. If your spouse runs their own limited company or you sit on the board of another business, HMRC could link them. And that could absolutely slash your thresholds and shove you into that painful 26.5% bracket way, way sooner than you expected. Okay, now that we understand the problem, how do we start chipping away at that taxable profit? Well, that brings us to Section 2, your capital investment playbook. This is all about turning spending you need to do anyway into a major tax advantage. You'll want to get your diary out for this one. There are some huge changes to capital allowances coming up, and they create a very specific window of opportunity. From January 1st, 2026, a brand new, very generous 40% first-year allowance starts for equipment. But then, just a few months later, on April 1st, the standard allowance actually drops quite a bit. And you have to remember that amazing 100% relief for new electric cars has a firm end date. The timing of your spending here is everything. So let's make this really simple. Here's your first big hack for 2026. If you're planning on buying any major new equipment, I'm talking new laptops for the team, specialist machinery, a new company van, if you can, hold off on that purchase until after January 1st, 2026. Why? Because you'll get to write off 40% of the cost against your profits in year 1. That is a massive tax deduction. And don't forget about the other powerful tools in the box. You've got full expensing. This is for limited companies only, but it's a real game changer. It lets you deduct 100% of the cost of most new kit in one go. Then there's the annual investment allowance, the AIA, which gives you a 100% deduction on up to £1 million of spending, and that can be on new or second-hand assets. And of course, for now, that brilliant green incentive for new electric cars is still very much in play.
Right, so that's buying stuff. But what if your business is creating something new? A new process, new software, a new product? Well, that's where the innovation incentive comes in. And you'll definitely want to hear this part.
So the whole R&D tax relief system has been simplified into one main merged scheme. Let's put that in plain English. It means you get a 20% credit on your qualifying spending. Once you factor in tax, that works out as a real cash benefit of about 15 to 16 pence back for every single pound you spend on innovation. We're talking about things like your developer's salary, the cost of materials for prototypes, or your software licenses. It's a direct injection of cash back into your business.
Now, stay with me because this is a really crucial update that catches a lot of people out. It used to be that if you hired, say, a development agency, they might be the ones to claim the R&D relief. The rules have flipped. Now, the relief belongs to the company that commissions the project and takes on the financial risk. So if you're that small cafe in Manchester paying a software firm to build you a new ordering app, the right to claim that R&D relief is now yours, not theirs. That's a huge change. Okay. Now, for what is, quite possibly, the single most powerful but most underused tax relief in the entire UK system. What if I told you that you could pay a corporation tax rate of just 10% on your profits? And that 10% rate comes from something called the patent box. If your company has profits that come directly from a UK patented invention, you can choose to have them taxed at just 10%. Let's put that into perspective. On £500,000 of profit, that's a tax bill of £50,000 instead of £125,000. That's an incredible £75,000 saving, year after year. Seriously, it's one of the best kept secrets in UK tax, and so many innovative companies just don't know it's there for them. Okay, let's get personal. Section 4 is all about smarter director pay. This is all about how you, the business owner, can get money out of your company in the most tax-efficient way. Now, stay with me here. This next point is going to affect almost every single director of a small business in the UK. So here's the alert. From April 6th, 2026, the tax you personally pay on your dividends is going up by 2 percentage points. It doesn't matter what band you're in, it's going up. For a higher rate taxpayer, the rate jumps from 33.75% all the way to 35.75%. The bottom line is, taking dividends is about to get more expensive. This date is set in stone, so planning ahead is absolutely crucial. So, how do you beat this hike? Well, there's a perfectly legal strategy called dividend forestalling, and it's a simple 3-step process. First, you need to make sure your company actually has enough retained profit. The official term is distributable reserves to legally pay the dividend. Second, hold a quick board meeting, even if it's just you, and minute it. Just a simple record that you've declared it. And third, and this is the most important part, the cash must physically arrive in your personal bank account before midnight on April 5th, 2026. That locks in today's lower tax rate. Now look at this slide, because this shows what is often the single most tax-efficient way to take money out of your company. It isn't salary, and especially after this tax hike, it's often not dividends either. It's a company pension contribution. Just look at the numbers. A higher rate taxpayer takes a £20,000 dividend. They'll pay over £7,000 in personal tax, leaving them with just under £13,000. But if the company pays that same £20,000 directly into their pension, they pay zero personal tax. And on top of that, the company gets a tax break of £5,000. It's an absolute win-win.
All right, let's wrap this up with our final section. A few quick wins that could make a real difference to your bottom line.
Here are 3 more reliefs to have on your radar. First, if you're in a creative field, think film, television, or video games, the tax reliefs are incredibly generous. They're absolutely worth a look. Second, if your business has a tough year and makes a loss, you can often carry that loss back to a previous profitable year and get a physical cash refund of tax you've already paid. And third, don't forget trivial benefits. You can give yourself small tax-free perks like gift vouchers up to £50 a time with an annual cap of £300. Look, it's not life-changing, but it's tax-free cash from HMRC, so why would you leave it on the table? Okay, we've covered a lot of ground, so let's boil it all down into a simple 3-point action plan for 2026. Number 1, time your big investments. If you can, delay buying that new bit of kit until after January 1st to grab that new 40% allowance. Number 2, beat the tax hike. Pay any big dividends you have planned before April 5th, and after that date, make pension contributions your number 1 priority. And number 3, leverage your intellectual property. If you have a patent or you think you could get one, get on the phone to your accountant about the 10% patent box scheme right away. And, of course, the important bit. Please remember, this has all been for general guidance. Tax is incredibly complex, it's always changing, and everyone's business situation is unique, so please don't rely on this as specific financial advice for you.
For advice that's properly tailored to your business and your goals, we highly recommend you speak to an expert. You can get in touch with the team at My Tax Accountant, who put this whole guide together. All their details are right there on the screen. And hey, if you found this guide useful, please do consider subscribing to the My Tax Accountant YouTube channel for more expert insights just like this one. So I'll leave you with one final question to think about. Looking at everything we've covered, which one of these tax hacks can make the biggest difference to your business in 2026? Thanks so much for watching.